In Canada, two things are important: health and credit. My name is Varan here from iCredit Mortgages. We have Eric Poblete from Equifax to share his wisdom of how to maintain a good credit, techniques, skills, why credit is important, and he's going to give all he got within the next 30 to 60 minutes. Eric, first of all, thank you so much for being here.
Oh, thank you
I know
very
how
much.
busy you are running the national sales team or national account management team for Equifax. It's hard to get hold of you, and thank you for coming in person to support us and support me. Really means a lot to me.
No, thank you very much. I mean, the most important thing from an Equifax perspective is education. So even though I'm a salesperson, I find that education is key. So going to situations or environments like this, where I have brokers and agents that also educate their customers, wonderful. So I always take that advantage to really work with people like yourselves to do this.
So let's start with, give us an overview of what are you seeing as the current trends in Equifax regards to delinquencies and payments, because that's a hot topic right now over the last couple of years, and especially last 12 months. So give us your overview. What are you seeing as a trend right now?
Yeah. So first and foremost, if I may, from an Equifax perspective, some people may not be aware, but Equifax is the credit provider or the key credit provider in Canada. And what we do is we consolidate all the information, financial information on an individual, put it all together, and then work with all the lenders, the brokers, the mortgage companies, credit card companies to provide them that information. So as we gather all this information, as you made mention, we see the trends. We actually see what's going on in Canada. So, we've seen the highs, we've seen the lows, we've done all the analytics during the COVID period, which was quite interesting in its own regards. But if we're talking about right now, we're seeing a lot of what people already know intrinsically. It's a challenging time. Inflation is tough for people. Some of the other things that are really challenging is regards to renewals or houses. When people want to buy a house, or even when they're renewing, it's tough with the newer interest rates. But, I take that with a bit of a grain of salt because, I'm a little older. And to that degree, my parents went through the tough times. You've heard the tough times where there was 18% interest rate and filling 2 or 3 kids in a room and that type of thing. Whereas today, everybody wants 1 kid per room with their own bathroom. So times are different. But if you do want to go to that, then you certainly have to adjust financially. But again, from an Equifax perspective, we are seeing those challenges. We are seeing more, for example, people missing payments. I think the last study we did, we saw 1.3 million Canadians actually missed a credit card payment, which has gone up. Some of the other things that we're seeing is people are now not paying all their credit cards. There was a time when people would say, okay, I paid my balance.
Yep.
Now what we're finding is people saying, well, I'm not paying my balance because I can't afford to, or what
keep the minimum payment.
Exactly. So it makes it very challenging. And then all those things line up. And then what happens is when you get back to credit scores themselves, what ends up happening is when you start to miss payments or when you start to have higher balances, all that stuff starts to reflect on your credit scores. And then that then becomes a bit of a vicious cycle. Because when you go out to buy a car, get a credit card, or buy a house, the lower credit scores will make it a little bit more challenging for you. So again, intrinsically, everybody knows we're hurting, but we have statistically the numbers that people are challenged in regards to moving on with their life, day to day, housing, or even just daily purchases themselves.
Are you seeing a bigger upward trends behind the mortgage payments?
In the mortgage payments themselves, it's delicate. So what happens is we're dealing with Canada. Canada is a little bit different than, sometimes you see the sensationalized things in the U.S., all these high delinquency rates and bankruptcies and so forth. Canada is a little different. You're going to find that a lot of Canadians will do whatever they can to keep their house. Okay. So, Canadians are notorious. They'll get a second job, a third job. They'll make their kids work, whatever be the case. But really, Canadians are a different animal. So it's a hard number to say, oh, we're seeing more delinquencies or more bankruptcies, because it's fairly level. It's actually not that high in Canada.
That's a good thing.
Which is a good thing. But it doesn't say the fact that people are not living a quality life. Because now, you've heard the term, they're mortgage poor, because they're putting all their money into their mortgage or the renewals or whatever. So maybe they're not doing all the other things. So that's the challenge you have is, yes, you want to own a home because many Canadians still have that dream. Many people new to Canada have that dream. They want to have a house. But will you do that in jeopardy of, a fairly nice lifestyle? Will you be able to, go out for dinner at a restaurant or not?
So they're sacrificing the lifestyle to keep the fuel going.
That's what we're seeing. Okay. And again, that's a challenge. And that's going to be a generational thing. Again, as I mentioned earlier, Canadians want to own a house.
Yeah.
It's starting to trend a little bit differently. We were just talking earlier about people in Calgary. Calgary never really saw a dip.
Yeah.
Well, what's happening? People want a house, but now they're starting to come to realization, I have to move to Calgary or Halifax or Saskatoon to get the house or the quality of life I want. So that's happening right now. We're seeing a lot of migration outside of the big cities like Vancouver and Toronto, moving out to all the other secondary cities, and they're doing well.
You got it.
But you got to make that decision though. If you want a house, where can you
The
afford
quality of life, right? It comes under the quality of life. Especially, I think COVID also helped a lot of people to move to the different areas.
Well, the COVID really gave the opportunity for a lot of people because in the past, and still a little bit, mentality was you had to be in the office all the time.
Yeah.
When COVID happened, we opened up a lot of technologies which allowed people to be a little bit more remote.
Okay.
Do things from a different location so that, I'm not tied to an office. And to that degree, it opened up opportunities to be able to move to a Calgary or what be the case and still maintain a good lifestyle.
Okay. Eric, so can you give us an overview of what drives the credit score? Like a lot of people don't know. Everyone thinks making the payment on time is the only thing. But you and I had training sessions before. That's not the only thing. So can you kind of give the audience some breakdown of what drives the credit score?
Oh, absolutely. So just a bit of a summary here. A credit score is the measurement of how well you pay your bills.
Okay.
So what happens is when you're going to banks and when you're getting a car, you're getting a credit card or a house or what be the case, you're working with a lender and obviously they want to know that you're going to pay your bills. You're going to pay your mortgage, you're going to pay whatever be the case. So to that degree, the score itself, a credit score, is really a consolidation of a lot of the items, wrapped around financial. And I'm going to give you probably the 5 key areas that really make up a score. First and foremost there is what we call payment history. And payment history is really the measure over the last 3 to 5 years of did you pay your bills on time? Because these are credit scores. And so the largest part or the largest weighting of a score is regards to have you been paying your bills on time? And that's recorded. So all the lending companies in Canada, all the credit card companies and so forth report to Equifax and they give you a rating. And typically if you're looking at your credit file, what you want to look for is a rating of 1. What it means when you have a 1 is you've been paying your bills on time. And that's wonderful because then that weighting of 35% of your score is maximized. If you pay all your bills on time, all the time, then it really helps you on your score, improve it or at least maintain it. Quick note, some people say, I got a bill for $50, I'll pay it next month. Well, it sounds all right, sounds normal, but the problem is that lending institution will then say, he missed the payment, he gets a 2, and that can start to affect your score.
Okay.
So easy advice, first and foremost, is just always pay your bills on time.
At least a minimum payment.
At least the minimum. As long as, I think the term we use is pay according to terms. So it could be the minimum, could be the interest rate, it could be $10, whatever the terms are. As long as you pay according to terms, then you'll always get rated a 1. The second area, though, and this is the interesting part, is what we call utilization. So this is, I've started to call the silent killer of scores.
A lot of people don't understand how that impacts your score.
My goodness, yeah. Well, that's exactly it. Utilization is when the amount of money you carry month to month. It's like your credit limit. How much are you carrying? So say, for example, I have a credit card that has a $5,000 limit. My utilization would be how much of that am I carrying from one invoice to the next. What people don't realize is when you have a high utilization, overall utilization, all your trades, that can affect your score greatly. So if you have, for example, 80, 90, or 100% utilization, if you're carrying a lot of money over, you could lose 100, 150 points on your score. So even though you think I'm doing great, because I'm paying all my bills and everything else, but if you've got a high utilization, that could sneak up on you and end up being, really affecting your score greatly.
That's what you call a silent killer.
I call it a silent killer because people don't see it coming. So that's really the other really significant area in regards to a score. The other 3 areas, one area is stability, which we call history. History is really, how long have you had credit? So the models and scores, the good thing about them is as you have good credit over a longer period of time, you build stability. And as such, if something happens, if you miss a payment, if you have a high utilization, well, guess what? If you've got a long, good history, the score says, that's a good person, and they won't really affect your score much. But the opposite's also true. If you've got what we call a thin file, if you're new to Canada, if you're a young couple, or if you've gone through a challenging time, if you had a consumer proposal or something, what ends up happening there is that same, let's say you miss a payment or have high utilization, because you're not as stable, that actually affects your score more so. Okay. So you have to be careful, especially if you're new to credit, that you have to do your due diligence, do things properly overall. Those are the bigger animals. The other two areas, they only affect your score about 10%. One is regards to what you have in your portfolio, like how many credit cards do you have, how many lines of credits and so forth. And most Canadians have an average, nothing crazy. A house, maybe a cottage, a car, maybe two, a couple of lines of credits, a couple of retail cards. That's fairly normal, but if you go a little over and above, and most people have, the area where that happens is credit cards. If you've got that person who's got like 15 retail cards, you know your friend who's got that giant wallet and it's just loaded with cards because they just love it. And
because every single time when you sign up,
I get free shipping and I get called this and I get advance notice. It's nice, but the problem is this credit scores start to look at you as credit seeking. And as such, it'll actually penalize you and say, hey, this person's got too much risk. And you can actually lose up to 10% of your score. So be careful when you have too much out there. And then the last item is really what we call inquiries. And this is actually interesting, the one that everybody knows about. Yeah. It's like, a hard inquiry. It's when you pull my credit file. So many Canadians have been so positioned that don't ever do that because it's like going to kill my score.
I'm glad you brought it up. This was one of the topics I was going to talk to you.
But it really is only 10% of your score is affected by inquiries. Only 10%. And in most cases, people do not do a lot of it. They'll do a couple here, a couple there because they're buying a car or getting a credit card. It's so, it's so minimal in the grand scheme of your credit score itself. Those other factors I told you, much more significant than an inquiry itself.
I get a question all the time. Give me a pre-approval, don't pull my credit.
Yeah.
I'm like, I cannot give you a pre-approval without pulling a credit. Oh, I don't want to lose my score.
Exactly.
So how would you handle a conversation? Because someone is seriously looking to buy a house, but they are so worried to pull the credit because they are probably 3 months, 6 months into purchasing a home. Mm-hmm. So how could you educate them and how could you give them a confidence or comfort that is not going to impact the score significantly?
Well, this is where education, both from going to the website such as Equifax.ca or even education through brokers like yourselves. This is your job, this is your specialty, is to understand credit scores. And you have to really educate them and support them and understand this is where it is. I think with a lot of consumers, the predicament is the credit pull is something they don't specifically control, so they like to sort of push the responsibility on somebody else. They don't want to take blame for it. Sometimes, be very honest with you, they don't really tell you about the fact that they've skipped 2 or 3 payments or that they went bankrupt 3 years ago. They don't seem to think that that's of any concern.
Yeah, that's true.
But really, those are the bigger concerns than the fact that they just had an inquiry.
How much scores can drop by pulling a credit score on average? Like, it's any magic number, magic scores?
No, there's no linear. So here's another, myth we have to break. There's no linear relationship in regards to activity versus the score itself. And part of it is, if you remember what I told you about, a lot of the different factors, one of that is stability. So, for example, if if I've had 5, 6, 10 years of great credit and I pull a credit file, more than likely, I won't even see a change in my score.
Correct.
But if you're somebody who's had, a very thin credit, and you pull a file, you could see 5 points, maybe 7 points, something of that nature. So it's really a lot of factors involved in regards to, that. I think the message I want to get across is it's not linear. There's nobody out there. If somebody tells you they know, they don't know. There's no linear relationship between you put $500 into a line of credit or you get this credit card or you pull a file once or whatever. There's no linear relationship. There's a lot of factors. But at the end of the day, from an Equifax perspective and credit scores, the key thing is it's about fairness. So really what we're trying to do is provide, our customers, this is a fair representation of Varan or whoever, of how he pays his bills over a long period of time. It's not that, you just paid all your bills today and then he's a great person. It's over a long period of time, how well has he done, his history. And that's what the credit scores do, is they really give more of a fair picture of you as opposed to just a snapshot per se.
So you touched a little bit about credit utilization and how it can impact the credit score. So what is the limit, like 50% over the limit or 60% over the limit impact the score? Like when you really see is impacting your score in a negative way, after what kind of balance and the limit?
Well, it's a very complex model, and depending on the different credit scores out there, there's different thresholds that might occur. So what I strongly suggest, and again, this is my opinion, is at the very least, always keep your utilization under 50%.
Under 50%. Overall, not just one. Overall. Okay.
Absolutely. But you are, when you're in different, for example, lending on a house, and there's different lenders, they may have their own threshold. I mean, I know some lenders that say, hey, if they're over 30%, don't even come to me. So you're in your best practice to do it as low as possible. I mean, it's hard, but certainly the lower you can have your overall utilization, the better your score will be. So really keep that in mind.
And especially the tough times like this, a lot of utilization that's impacting. I'm seeing a lot of clients, they want to come to do a refinance to consolidate the debts, but the lenders are looking at the credit score and say, hey, what's going on? Why is it overutilized? And that's actually impacting them. So just kind of look for an advice before it's too late.
Yeah, it's hard. I mean, in most cases when people, it's kind of funny credit. I always tell people, when you want credit, nobody will give it to you. But then when you don't need it, everybody wants to give it to you.
That's true.
So it's kind of an interesting animal about that. So I tell a lot of people, as advice, personal advice, I say, if you are offered additional credit, I suggest take it.
Take it.
But
don't use it.
Don't use it. It's the discipline. Because remember, what happens credit, it's not about how much credit you have, it's how you manage it.
Yeah.
So you can have $1 million lines of credits and you can have all these things all over the place. It's how you manage credit that gets you the score.
Okay.
So again, get the higher limits, which is wonderful because mathematically
algorithms
it drops down your utilization. But don't use it because once you start to use it, you dig yourself into a bigger hole.
Okay. So the utilization is also impact when you use a secure line of credit as well. Or is it on an unsecured line of credits?
So from a standpoint of line of credit, it's a sort of a loaded question, I'll tell you honestly, because I'm going to give you a little history about, or not history, but a little bit of the process of Equifax.
Okay.
So Equifax is a reporting agency. So we at Equifax do not take or modify any information.
We take what the lenders give you.
Consolidate all the information all the lenders give us, and as such, we then put it together and then add it into the models to create the scores.
Yeah.
So why do I say it's a loaded question? Because depending upon how the lenders treat their different products, it may or may not affect. So you say generically, secure or unsecure, but that means a lot of things to a lot of different lenders.
Okay.
So I just have to advise you that depending upon how they report it to Equifax is how it gets treated in the system and then how it gets treated onto the scores themselves.
Got it.
If you really are concerned, you absolutely should talk to your own lender and find out. Because again, lenders report it a little differently.
What is the reason, Eric, you can see a different score when I put my own credit bureau and when I go to the lenders? What's the reason?
Well, that's a great question. And I think it goes back to a little bit of the myth. It's only been recently, I'll say right now, over the last 10 years that Canadians have started to understand credit. Started to see it, started to read it, started to understand it. But I always joke, it's that whole cliche or adage where you know enough to hurt yourself. Okay. So people are looking at that and they start to see it. It goes, I now know everything. But they really don't know everything. So the one challenge we have is when we talk about credit scores itself, people are all thinking there's only one credit score out there. But there isn't. In Canada, I personally know of at least 20 different credit scores. Okay, and then on top of all that, there's banks that have their own credit scores.
Yeah.
So what ends up happening, a credit score is a model. It's an analytical model, that likelihood of how you're going to pay your bills. But they're all built differently, built in different years, different decades, different criteria, different data sets. So to that degree, what you're going to find is all the different scores will potentially have a different score for an individual. So how does that help a consumer? Not easily. So if you're a consumer, when you look at all these different scores, you should look at them as guides, as coaches. It's like, okay, I'm kind of trending upwards or what, but don't get too hung up on the score. But ultimately, when you're doing something, if you're going to buy a car or if you're going to buy a house or whatever the case, the most important score that you should be looking at is the score that the lender is looking at.
Got it.
So if the lender is looking at a specific score, that's the one you have to focus on because all the rest are nice, but the lenders aren't looking at that. And there's some consistency in Canada, which is good. In Canada, in the mortgage space, we all look at a FICO score 8 by Equifax, which is good. So the brokers are looking at it, the lenders are looking at it, as well as the mortgage insurers. So there's at least consistency. But I will tell everybody there is a challenge because the FICO score is not available to consumers to buy. So more than likely when they do come to you, they picked up a score from Credit Karma or Borrowwell or even their bank, and it's not going to match. So I tell people or brokers, it's your job to educate them and explain to them, hey, there's different scores out there, but here's the score we have to focus on. And this is why, you have to look at this moving forward.
Because I have 700 beacon, give me a pre-approval. I'm like, That's mean nothing to me.
Well, just so you say, when you say 700 beacon, no, it's not. It's a 700 score of something else.
Something else. It's not a 5-star.
Everybody just throws the beacon afterwards,
Yeah.
thinking it's all the same thing, but they're actually different scores.
Okay. What is a consumer proposal?
So a consumer proposal is when a consumer, cannot pay all their bills. And what they do is they legally go to an entity, a trustee, who will help them to basically manage their affairs, figure out what's the best way to pay the bills, and reach an agreement with different lenders or different people who they owe money to, and basically say, okay, I contractually will go to you and say, I will pay these bills over a certain period of time. There might be a reduction in the amount that needs to be paid, but it's an agreement that they reach between the two of them. And some people do that because they don't want to do a bankruptcy where they just declare, that they're not fit. So most Canadians, if you need to refinance, it's a little bit beyond just refinancing. It's now you have to get it into a contractual relationship. But certainly a lot of Canadians are going down that way because when they do it that way with a proposal, they do get to keep a lot more of their assets. It's, when you go into bankruptcy, your assets get put at risk. Whereas a proposal is really about the monetary scenario.
Got it. And can you reestablish a credit easily after the proposal? Like how easy it is to?
Can. No, credit is always ever changing. Now, don't get me wrong. It is challenging when you get into a situation where you do a proposal or a bankruptcy. It does have negative marks on your credit score. So please, don't think that, I've just done a proposal, next week or next month I'm going to have a great score. There is a time that's going to take you to build that back up. And I'm going to say very honestly, probably over 6 months to a year, it's going to take you where good practice will allow you to build your score back up. But it certainly is there. And the information on a proposal does stay on a credit file for up to 3 years. So keep that in mind, timing-wise. After 3 years, that information will drop off. And you'll start to, if provided you've been doing good credit history, you're going to find that your scores will improve after a year or two.
And the bankruptcies stay there for 7 years.
Yeah, the challenge with bankruptcy is they're there a little longer as well. So that's sometimes why people choose proposal versus bankruptcy, because bankruptcies stay on your credit file from up to 6 to 7 years, whereas proposals only last for 3 years. So that's another reason why people will go down that route, to be able to get themselves back on their feet quicker.
So how are you seeing the fraud? Like I know a lot of things comes through it. Are you seeing any increase in fraud, or it's been leveling off? What are you seeing in terms of fraud?
Well, fraud, yeah. Well, unfortunate scenario is fraud is always around, and it always takes the opportunity when things are sort of happening. So case in example, you go back a few years with COVID, a lot of what we call third-party fraud occurred. Third-party fraud is when you have fraud where it's somebody else doing the fraud. So be it the organized crime or somebody else, that individual that steals 100 IDs and things of that nature. So during COVID, a lot of that happened because basically everybody was stuck on their computers, everybody was remote, and as such, a lot of third-party fraud increased over there. In recent times, the biggest challenge that we have now is fraud, especially in the housing industry. Year over year, we've seen about an 18.8% increase in fraud. But let me define that a little bit more clearly. What we see a lot of in housing and in mortgage is what we call fraud for housing, first-party fraud.
Yeah.
First-party fraud is different. It's fraud where the individual is actually providing fraudulent information, and we sometimes see that as falsified financials, or maybe their employment is I work somewhere, I'm a VP when they're really just a manager, or things of that nature, or income is falsified.
Yeah.
That's still considered fraud from an Equifax or even from an industry perspective. So we've seen a lot more of that occurring, and that's part and parcel to what the fraud is when you're falsifying that information, you're not providing a true picture of yourself. Yeah. So we have seen, as I mentioned earlier, about 18.8% increase in fraud.
That's a big number.
Yeah, and part of the reason around that is the challenge. I mean, as I mentioned earlier, everybody wants a house. Yeah. Everybody wants to live in a house.
Canadian dream.
And everybody wants the Canadian dream, but they also want to pay the best they can. And you can't get the best rates unless you have a good credit score.
On income.
And, and so to that degree, what ends up happening is people will do different things to try to make it look like they're in a better position so that they can get a better terms and conditions. They can get a lower interest rate because they want the bigger house.
And want to keep the payments small.
And they want to keep the payments small. So that's the challenge is they might go to fraudulent activity, and I'm going to say fraudulent because they're misrepresenting themselves to try to get that better dream. And that's a challenge because, really you'd like to have and give everybody everything, but you know what? If you can't afford it, you're just setting yourself up for failure in the very near future.
There's a lot of new immigrants coming in. Mm-hmm. What suggestions or advice you can give them to build their credit?
Yeah. Well, twofold. One is I gave some advice earlier about the good habits.
Yeah.
So absolutely, when you're new or when you've got a thin file or a new file, always pay on time. Always keep utilization low because it's going to be very critical and it'll affect your score more greatly. But the second aspect is always try to get credit that does report to Equifax. So this is interesting because some people say, "Oh, I'll just get any credit card." Sometimes you get credit cards that are marketed to new to Canada, but they don't necessarily report to the credit companies like ourselves.
Okay.
If we don't see it,
You don't know?
it doesn't exist, so it doesn't help you on your score. So really what we suggest to a lot of new to Canada is absolutely get a few items, even if it's 2 or 3, but start to use it and then start to pay the bills accordingly and on time. Because again, remember, we talk about how you manage your credit, not how much. So you don't have to get a $50,000 line of credit if you're new to Canada, but if you get something and you use it and then you pay it on time, that'll be all aspects of really helping you to improve your score. It's really about, again, we want to see that you have good habits, and to that degree, it'll reflect on a better credit score. And typically, it'll only take you about 6 months, 3 to 6 months for you to actually start to evolve a score, get a score, and then be able to work on that from an Equifax.
And the lenders also know it's a thin credit because they're new to Canada.
Oh, absolutely. Bear in mind, it's what we call a thin file in the mortgage industry. So you've got to look at a lot of other factors involved when you're going to buy a house. But at the very least, you want to at least have a good credit score.
Okay.
So really, you follow the good practices early, and get a few items that do report to Equifax. That's really the starting point of where you then start to, build your financial background so that you can buy a house.
Okay. Can you comment on the new thing in the budget about reporting the rentals into the credit bureau?
Yeah, that's actually a hot topic. I mean, we've been working on that from an Equifax perspective probably about 6 years.
Oh, wow.
So, but we're very, how can I put this? Equifax is very methodical and we're very conscientious because we're dealing with private data. We're dealing with a lot of data. We're dealing with a lot of information. So when it was brought to the exposure by the Prime Minister in regards to, hey, Equifax is looking at working with rental, absolutely, we want to look at what we call the unseen. Our president calls them the unseen. These are people that have, been paying their rental for, let's say, 10, 15 years, paying it wonderfully, maybe paying $2,000, $3,000, $4,000 a month perfectly for years. But unfortunately, on a credit file, it doesn't come up. It doesn't give them the benefit of such. So we know that from a high level, that's not right. We have to find a way to report the fairness of an individual. But the challenge becomes logistically. So if you think about it, how many landlords are there in Canada?
Small landlords.
Small landlords, big landlords. How many Canadians are there? How many Canadians are moving around? So the big challenge we have from Equifax is, first and foremost, is how do we get all that information accurately and consistently so that it is meaningful for a credit file. Okay. Because those are important. You can't just randomly put information on a credit file. It has to be consistent and it has to have a large sort of scope. Second of all, when we're looking at all that, we have to be conscientious of how does that affect the credit score itself. So just so you know, we have been looking at it, but we haven't really gone into a full effect. We've been really measuring, I don't maybe call it test samples, but there's been a small amount of people that are reporting rent. Yeah. And we're starting to see how the effect is on the credit scores. We're doing analytics and studies and so forth, but it does take a while. As I mentioned before, we've been working on it for a while. We want to, and we have an ideal goal for it. How soon? I can't say, but certainly the ideal goal is, it is a very, strong representative of an individual, how they pay their bills.
So it's like paying a mortgage,
we
right?
we think it's like paying a mortgage. So we think it is valuable. It's just a matter of getting there and then working our way through the logistics of that.
Got it. I don't know how true it is, but maybe it could be a rumor. Is Equifax going to be part of the digital income verification that CRA is proposing?
That who's proposing?
The CRA is the government is proposing.
So another project we've been working on a while as well.
Okay, so it's not a rumor then.
It's not a rumor. We've been working on it for a while, but it's challenges. When you work with many different government agencies, we all know intrinsically that information available would be very helpful for adjudication, verification, reducing fraud.
Yeah.
Oh my goodness! If you had that information, you could reduce a lot of transactional fraud because you actually had the true number of how much people made or how much they owe or what be the case. So it's us working through all the government agencies, working through associations, trying to figure out what is the right path to be able to do so, because we really think that is an ideal way to really reduce fraud when we know that. And on top of all that, put people in the right place.
Correct.
If you've got all the right information from a government perspective, that's a good place to be. But, Canadians are also, how can I put this, very private.
Yeah.
So, in the U.S., you're going to find that a lot of Americans will just give all their information and they're fine. What be the case, police records, they're really good that way.
Yeah.
But Canadians are very private. So to that degree, Canada and the politics, they balance that out of, do Canadians really want to give all that information available to other entities, third parties? So there's a balancing act in regards to that. Even though ideally we know it's a good thing, certainly we have to work through the process as well. So a little bit of a long answer, but definitely we are very interested. But again, it's about the process that's really more important. How do we do that properly, fairly, and in a safe manner?
So, Eric, a couple of things. How can you get an international credit bureau with Equifax?
So not yet. So from an Equifax perspective, we do absolutely have a relationship with the United States because you have to remember we're talking about private data.
Yeah.
Private data crossing borders. So a lot of lawyers have to get involved. A lot of processes have to get involved. So we're very fortunate that from a Canadian perspective or North America, we do have that relationship across the border. But when you talk about other countries,
Like England.
yeah, it's a tougher. I mean, we have to have those relationships across the board. And also keep in mind, we're I'm not saying jaded, but we have this understanding or belief that credit exists around the world in the same way. You'd be quite surprised when you go to other countries, South America or even, towards Russia or so. Credit doesn't exist in that manner. It's a lot of money. It's a lot of financial transactions that are passed off. But the actual, concept of a credit score doesn't actually exist in a lot of countries.
Okay.
So notwithstanding, when you talk about how do you get international, at this point in time, Equifax only really has that relationship with the U.S., but in the horizon, probably in the next 6 to 12 months, you are going to find Equifax is actually evolving because we do see more and more new to Canada coming. And to that degree, the need is becoming much higher. So we were actually looking at who's coming to Canada and approaching those countries and saying, hey, this is important to us. Can we build a relationship so that we can actually pull a credit file in that?
Help these individuals.
Well, help the individuals as they cross borders, or have it done before they even come across. Maybe set it up so that the credit file will follow with them, or what be the case.
Got it.
So it is coming. I'm not going to let out too many secrets because we have a few tests in the works right now. But just keep in mind, if you think about it, whatever countries are the most coming to Canada are probably the ones that we're really looking at working
Makes
with.
sense. Okay, that's answers. Eric, how long it takes to take the late payment out of the credit bureau? Like, how long it usually takes the R9 or R3 to go to the bureau?
Well, again, as I mentioned earlier, the whole thing about credit is it's about the long-term, picture or image of an individual. So to that degree, we do have purge rules from an Equifax perspective. What we mean by purge rules is how long do we hold the data? So you will find on an Equifax credit file that our purge rules are typically maximum about 6 years.
6 years, okay.
So when you have, I hate to say a bad payment or a negative or a bankruptcy, it will stay on your credit file for up to 6 years. It will drop off after because, again, what you did in high school or university, is not necessarily reflective of how you are today.
So you don't want
to that degree,
punish.
we again, it's all about fair and equitable. So we don't want to punish somebody for bad habits they had when they got their first university credit card and everyone went crazy. We don't want to punish you for that. But certainly, there's a certain period of time, which is about 6 years, where we say that's fair and equitable on an individual. And to that degree, your credit score and your history will be reflected accordingly.
Okay, perfect. So help me to understand this. So a lot of times I get a pushback from the clients. My credit is being pulled by my bank or the broker I was been dealing with. Yeah, they told me if I pull the credit again, my score is going to drop. Can you kind of walk me through? Is it true? How can I overcome that objection, or how can I educate my clients?
It's a hard thing to overcome, and the reason because there's a lot of people that keep perpetuating that. I kind of joke with people because it kind of seems like the bank or that broker is really just putting the fear of God in you, or the fear, the fear
I
of
know
score
that.
of you.
We know
They're
that.
like, don't go anywhere else.
Yeah.
You can't go or shop anywhere else. You have to work with me, or else it's going to hurt your score.
Correct.
But reality is, when you look at the credit score and the way it's weighted, the way that the model is put together, inquiries are really one of the smallest components of a credit score overall. I'm not saying go crazy. Don't go everywhere. Don't go find 10 different brokers. But certainly when you go to one or two, you're going to find that, it really won't affect your score in any degree. Even so much so, I will also sort of quell one myth. In the mortgage space in Canada, with the mortgage the mortgage score that we use, which is the FICO score 8, there's actually a shopping capability in that score.
Oh, okay.
What that means is, let me elaborate. What that means is, if you're shopping for a mortgage in Canada, and you go between different brokers and so forth, within a 45-day period, all those inquiries are actually treated as one event.
So the system knows.
So the system knows that you're shopping for a mortgage and won't penalize you for it. So even if you did go from one lender to another or one broker to another, within a certain period of time, as I mentioned, 45 days, it actually will not affect your FICO score.
Got it.
So really, again, it's education you have to provide to your consumers. Because again, we're not trying to there to punish you. This is one of the largest purchases you're going to do in your life.
You want to make sure you got the right product.
So we want to make sure you have the time to do the shopping around and not feel that you're restricted. So that's why, again, all the lenders and the insurers are all really focused on the FICO 8 score, because it does give you the longest period of time to do the shopping around.
If someone looking to get the best source of information, or they want to educate themselves, they want to learn more about how to rebuild their credit, how to keep the best credit score moving forward, where they can get some information, or how can they reach you?
Yeah. So I would highly suggest, so over the last few years, Equifax.ca has been probably one of the best sources of education. We have tutorials, we have webinars, we have videos. So absolutely, if anybody wants to learn more about credit and understand credit, then definitely Equifax.ca is probably your best source right now.
Perfect. Thank you, Eric.
Thank you very much.